What is a stock option? Well, a stock option is an agreement that gives the right or the obligation to buy or sell 100 shares of a stock for a specified amount for a specific time. For a call option, after you purchase 100 shares of XYZ stock, you can sell that opportunity to an investor to buy those shares from you at a higher price for a fee. Now, a real summarized kind of example of what I'm referred to would be like having 100 shares of XYZ company that you bought for a certain dollar amount, and later having an agreement, an obligation as a result of having, for example, a covered call option to sell those shares to an investor at a higher price for a particular designated amount of time for actually a fee. And we're going to cover an example in more detail later in the course, but that's just an overview. All right, for a put option, when you have the money in your account to actually purchase 100 shares of, let's say, XYZ stock, you can actually sell the opportunity for an investor to actually sell you their shares at a discounted price if that stock goes down to a certain strike point for a specified amount of time. So you're getting paid for obligating yourself to actually buy the shares of the stock at a discounted price. So you get paid for guaranteeing that if the stock goes down to a certain price, you will buy it. And the main point is, for that particular situation, you need to pick stocks that you love enough to actually want to buy them at a discount. In this particular case, for cash secured puts, you are effectively selling stock price insurance to investors wanting to protect against the downside price risk. And we will cover a detailed example in this course. Now, with put options, it's very, very, very important when selling put options to pick high quality stocks in which to sell cash secured put options to decrease the risk of the stock going down drastically or going down to zero. So that's why you're not picking a diamond in a rough, you're picking a diamond off the shelf. Because with selling cash secured put options, you are guaranteeing to buy that stock anyway. If it goes down to zero or goes down below the strike point or goes down just to the strike point. So that's why it's very, very important to pick a stock that you love, that you have confidence in, that is a high quality stock. Now, you can buy your own put beyond the cash secured put you sold to protect yourself from the stock going down to a certain level. You just give up some profit to do that, and that will be covered in the course too, where you can actually buy yourself insurance below the put option that you've sold. But the main thing is to be sure that you pick high quality stocks for which to sell cash secured puts. Okay, as we continue to talk about options, let's talk about the different prices. You have a bid price, and that's the price to sell your stocks option. You have an ask price, that's the price to buy your stocks option, and you have the strike price. And that price is the price you agree to buy or sell a stock for the specified option. Now, for the call option, in the money, that represents an option that is at a strike price less than the current market value of that company's stock. And for a call option, out of the money represents an option that is at a strike price that is higher than the current market value of that company's stock. So if it's out of the money, it's higher than the current value of the stock. If it's in the money, it's lower than the current value of the stock. And you sell, if you're going to sell options, you're selling at the bid price. If you're going to buy the option, you're buying at the ask price. As we talk about stock options, we talk about different prices. For your put option, it has different prices, similar to the call option. Bid price will be the price that you sell your options for. Ask price, the price that you buy your options for. The strike price, that's the price to agree to buy a stock for the specified option. Now, for a put option, the term in the money is a little different than the call option. That is, the strike price is higher than the current market price of the company's stock. So think of it as in the money is when you're talking about a put option, the price is higher than the current market value for that particular put option that's in the money. Now, for a put option that is out of the money, the price is lower than the current market price of the stock. What should you have at this point? You should have a brokerage account in which you can actually buy and sell cash secured call and put options. A working list of stocks with weekly options, and that was covered earlier in the course. Enough money to purchase 200 shares of one stock, and that is to allow for you to sell a cash secured put option and also dollar cost average and buy more stocks to make your average price of the stock better. Also, keep in mind, in order to actually sell a call option, you need to purchase 100 shares of that stock. 100 shares represents one option. Exercise time. Time to grow. You will need to pause the course through the next 3 slides for the exercise. And in this exercise, as we walk through it, let's evaluate which of the stocks are best for the call options. And this will be the stocks, one of the stocks from your stock list. So do the below steps and then continue the course. And what you need to do is, of course, log into your brokerage account. This is not a race, by the way. Take your time. And from your brokerage account, put in one of the symbols of one of the stocks you have on your list, your chosen list of stocks. Look around in your brokerage account and find the options chain or tab. Now, it will be in different places in different brokerage accounts, but the goal is to navigate and learn how to navigate in your particular brokerage account and find how to execute trades and where the information is located. Looking down at step 4, locate the table with the call options information for your stock. As the exercise continues, notice the call options table shows dates, bid, ask, and strike prices for different call options. So pay attention, be very, very aware and familiar with where these things are located and how to view them. In particular, as you're looking through for your particular chosen stock, you're trying to decide what you are willing to pay on average to get up to 100 shares of that stock. And keeping in mind the value of the stock is going to change. So you're trying to get some idea, okay, how much I want to pay for this particular stock. Doesn't have the exact number, just you're trying to get an idea of what would I want to pay. The objective is examine the bid prices. So you're looking at the bid prices of out of the money options. So those would be the options you are selling. You're wanting to sell those options. So out of the money bid prices. And what the different strike prices are to see if the bid prices are at a level where you can actually make money selling that particular option. So you're doing a search and you're looking around and looking at to see what the different bid prices are, because in some instances the bid price is not high enough to even sell a covered call. So for call options, you sell the option at the bid price. So you're looking at how much can I sell this option for? And this is a continuation of the exercise. So this also is covering information relative to clearing, how you would clear an option. For example, if you clear it out. So to clear the option, the ask price is what you would pay to buy the option back. So that's why you're paying attention to the bid price, the ask price. You're trying to find out what those values are. In the event that you decide that you want to clear that particular position out, then you want to know what the ask price is, because that will be the price you're paying to buy that option back. Keep in mind, the closer the ask price to the current market price, the higher the bid price, and the more likely that option has the possibility of getting assigned and the stock sell out. So review your list of stocks, pick stocks. You want to pick the stock with the highest bid price for your chosen strike price. So you're trying to find out, in simple terms, which stock has the higher potential to make the most money. And the most money is determined by what you can sell that option for, and that would be the bid price. All right, at this point, you restart the course. All right, here's a concept. It's the concept of buying 25 shares at a time at different prices. So you could buy 25 shares at different prices. You could buy all at once or other different combinations, but this is just an example to show you that as you buy when the stock is declining or going up or down, if you do a dollar cost averaging type of buying scenario, you can get a good average price for the stock. Some time may be required to get the best price because the stock fluctuates over time. But the name of the game is being happy with how much you pay for the stock as a result of buying it at different price points. But one way to do it would be to buy 25 shares at a time at different prices. And we're going to show an example of that coming up. Now, here's an example of dollar cost averaging with a company where this is showing dollar cost averaging when you buy, like say, 25 shares at a time at different price points. Now, as shown here in the graph here, we have different price points for this particular stock. We have a $10 price point, where let's say the stock was at $10 at one point in time, $18 price point, $30 price point, and $22 price point. So in this example, if you bought 25 shares at $10, 25 shares at $18, 25 shares at $30, and 25 shares at $22 a share, you would get an average price when you add all the different instances, the 4 instances of adding those purchases together, $250, $450, $750, and $550. You divide that by 100, now you have an average price per share of $20 per share. So the idea is to not buy the shares necessarily at the same price when you're doing dollar cost averaging, so that you get an average price for that particular stock. Now, if you look at this particular situation here, and you look at the bid price for the example below here, the bid price of the out of the money option in example. You look at the $22 strike price for, in this particular example, the May 15th call option. You see that, assuming that you have a $21 current market price, you see that the out of the money option is here at 15 cents a share for the bid price and 20 cents a share for the ask price. And this is just, and we're going to go further in this example, but take a look at this and see how you could actually approach this particular situation and actually make money selling a call option. Okay, as we continue. Now for the $22 call option, the ask price is 20 cents and the bid price is 15 cents. So if you sell the call option for 15 cents, you get $15 per contract for each 100 shares. Okay, for this call option, if you sold a cover call option for this example, let's say you have a $20 average for XYZ stock. Now, we're going to look at the numbers here. Now, for the May 15th, in this example, 2020, $22 call option, which is an out of the money call option. Keep in mind that you have a $20 average because you did dollar cost averaging to get your average to $20 for the particular stock. Now, let's say the option expires May the 15th if this option expires under the $22 strike price, since you sold the $22 out of the money call option, you would get the $15 because you sold the $22 strike price for 15 cents a share, and 100 times the 15 cents is $15. So for this week, you would get $15. Now, $15 divided by the cost of 100 shares at $20 a share, you would divide $15 by 2,000 in this case. You would get 0.0075. To convert that to percent times 100, that would equal to 0.75% return minus any additional fees for this particular week. So that would be the return you could get for that week. So think of it, almost you're getting 3/4 in this particular case. This would be 0.75% for 1 week, which is a pretty good return in this example. So what we're after is trying to make a weekly income. And this particular example is showing a 0.75% return for a week. So that just shows the potential that you have with selling covered calls. So let's move on. Now, here's the example, and we're going a little further. Now, what would happen if you get called out of the option? And what we mean by called out is the option gets exercised by the buyer, because let's say the current price is either at $22 a share or higher before or on, in this particular case, May the 15th, 2020. So in this particular case, keep in mind that your average price for the stock is $20. So you get $2 more per share because you sold the $22 strike price. So in this case, this week you would get the $15 because you sold the $22 cover call at 15 cents a share. Also, you get, because you got called out, you get $2 a share more because your average price is $20 a share. So in this case, $15 plus the $2 a share, which is, since you have 100 shares, that's $200. So $215 is what you would get for this particular week. And if you divide that out, you get $215 divided by the $2,000 you have invested, and that's 0.1075 times 100. So in this particular case, for this week, 10.75% return minus additional fees. That would be the return for 1 week. So that's the power of selling a covered call and getting called out, but having a very, very good average price per share. Noticing that in this particular case, you get $2 more per share getting called out. Okay, exercise time. Pause the course and identify similar below items in your brokerage account. So be aware of where these particular tabs are when you are actually putting in a trade. So in this example, assume you own 100 shares of the stock of choice. So from that list that you generated in the prior portion of the training course, pick a stock and log into your account, put in the stock symbol, and select the options tab for your stock of choice. Now, find an out of the money call option that you want to sell. So this is time to now find an option that relates to the particular stock of choice. Now select the bid price for the call option you want to sell for the desired date. Now in this case, for XYZ stock, in the date field, I'm saying this is the example is for May the 15th, 2020. Now the strike price is what price you want to sell the option for, the out of the money price you want to sell the option for. The type of option is a call option because in this case we're doing a covered call. This is very important in the action. We want to sell to open. How many contracts you want to have, how many option contracts, one option contract. You see limit down here, we're putting limit because we want to either sell it for the amount it has or higher. That's what the limit does for you. In this case, we're trying to sell it for 15 cents, which is the bid price. And I'm saying keep this trade active good until canceled in this particular case so that it will actually execute if the conditions are met. So I won't have to put this back in again. So take your time, stop the course, take a look at your interface in your brokerage account. And this is not something you need to do really, really fast. So this is looking at an example and practicing. And you don't have to put the example in and actually go all the way through, but this is looking for these particular items to see where you would actually execute this trade. This is not a trade you have to execute, but this is what you may see in your account if you were to execute it. So stop the course, take your time, take a look, and see if you can find different areas in your brokerage account where you would see types of items similar to these. This is a continuation of the example. Now this is still assuming that you have 100 shares of the stock. Now if the call option's $22 strike price is not reached before or on May the 15th, 2020 in this case, and you want to clear your obligation, you want to buy the option back, and you want to sell a new option, this is what you could do. Now, keep in mind that if you do not buy the option back and it doesn't reach the conditions, it will actually expire worthless and it will clear itself out before the next trading day. So in this particular example, what you would do is pick the stock option that you want to clear for the date, in this case 5/15 for the example, the strike price that you sold the option for. It's a type call option, and very, very important, the action would be buy to close. So you're buying to close, so you're closing out the option. Ever how many options you have sold that you want to buy back? In this case, we're saying one. We'll do an example for one. We're doing an order type limit. And the limit price, if the ask price, which is the price you would buy the option back, happens to be 1 cent, then you can buy the option back for whatever that ask price is on the expiration date. It could be higher, but if it's 1 cent, you could buy it back for 1 cent, which is equivalent to $1. So you can close this option out, buy it back, get rid of your obligation to sell those stocks for whatever the ask price is. And if it's a good until cancel, I'm just putting that in so that I could do this any day of the week. It doesn't have to be the last day of it doesn't have to be the expiration date of the option. It can be an earlier time. If you want to pay more, you can pay more to buy it back, whatever the ask price happens to be. So take your time, take a look at this example and understand this is how you can have your obligation removed to actually sell the stock, and actually then you can actually sell another option. So the power of this is you can clear out an option for a discount, and you can actually sell another option for the next week. So take a look at this, take your time and review it and see what you would do in your account to actually implement this. But you don't have to implement this. This is just an example of what you could do.